I'm Daniel Schwartzman, Director of the Seeking Alpha Marketplace. Continuing our Roundtable series, today we're talking energy again. I'm speaking with Laura Starks, who is the author of Econ-Based Energy Investing, a service that offers long ideas for oil industry players based on 30 plus years of experience. So, Laura, good morning. How are you doing?
Good. Glad to join you, Daniel.
Great. So, we actually did a roundtable, a written roundtable over a month ago, and oil is moving fast like the rest of the market. And it's I didn't look at the quotes today. I don't know where we are, but coming into today, we're recording this Monday, June 8th. It's almost back to where it was 3 months ago before the big OPEC news. And OPEC announced they're extending cuts over the weekend, or it was reported anyways. Is this sustainable? Like, what's going on? Is this something that can stick?
Um, I think so. I would say that my perspective is that in the last part of the year and kind of into the beginning of this year of 2020, before the pandemic, that we were at like $50 to $60 a barrel, and then it kind of crashed. And now there was a point where somebody said, $25 a barrel looks good. And the price, when I last checked it, it's around, for WTI, it's around 38, 39, and Brent is a little bit higher. So I think that it is very sustainable. OPEC has the usual problem that they have with, people saying they'll do one thing and they do another, and and they overproduce. They seem to have addressed that through a series of negotiations last week, and they've said, look, we're extending it a month, and Libya is going to produce more, and Mexico, which doesn't have whose production is declining, is going to produce more. But I think it is very sustainable. I just think that it was such a gross miscalculation on the part of Saudi Arabia in March to start waging an oil price war. And they hurt themselves so badly that I don't think they want to see that again.
So, in other words, the big dynamic shift here is that they've learned their lesson, and so now they're more willing to cut and to maintain cuts to maintain the price of oil.
And it isn't that they haven't, you know, in 2014 or 2015, there was this big, surge of production from OPEC trying to drive out shale producers. And it didn't work. I mean, here, this is the first time they tried to do that on top of a 30% drop in demand, which was just, you know, crazy.
So,
So,
the related to that, we talked a lot in that article about the supply glut, and the impression I got, and obviously I'm not in the industry, I'm still sort of a generalist, but it felt like it's going to be a long time to winnow away that supply glut. The math set dictates, even if we go back to normal a lot faster than we were expecting a month ago, how that doesn't seem to be holding back the market at this point. I know we're still at the low 40s rather than 50, 60, but what's the dynamic? Because there still is a lot of supply out there. So what's the dynamic there for investors to consider?
I think there are a couple of things. One of the things that is worth sort of thinking about on the supply side is that in the US alone, we were producing 13.1 million barrels a day. And now we're at 11.2. And that's due to, shut-ins. But for the US, there are two parts to the supply dynamic. One is the shut-ins, but the other, which people are kind of not really paying attention to, is the reduction in budgets. Virtually every company, cut their budgets in half, 40, 50, 60%, their capital budgets. And what people forget, and it's very easy to forget about the shale production, is that it is just a capital machine, a capital hog. And if you're not putting money into production, if you're not drilling new wells, your existing production declines by as much as 40% a year. And so you might bring back your existing wells, but all of a sudden you have all this other production you're going to do that was kind of going to keep you even or better, and you're not doing it. So and as I understand it, part of the discussion between Saudi Arabia, Russia, and the other OPEC members was saying, look, here's where we think U.S. production is going to be, and it's not going to come roaring back to 13 million barrels a day. So that's one thing. Another thing is that the producers were crazily overproducing for several weeks. Refiners were not. The refiners are very market sensitive, and so they immediately cut their throughputs to about 70% from maybe, I don't know, 85 or 90%. And so they didn't flood the market in the same way that the upstream producers did.
So the two questions there are: did they see, first of all, did they see a backlog? Did the refiners get kind of fill up with theirs because they're taking from upstream, so they must have been sitting on more oil than normal.
Well, I mean, the refiners could just always say, hey, we're not buying it, we're not taking it, we're not whatever. So, what was happening was the producers were scrambling to find someplace to put this production, and that's when it sort of, hit home that they couldn't keep producing at those levels because they couldn't find enough empty tankage or empty tankers to put it into. I mean, that was an aspect of it.
Right. So then the other question there is when we talk about capital budgets, because one of the interesting things in these conversations, first of all, does this mean that we're in the final phase of oil in the sense of oil? They're going to stop drilling and trying to expand their reserves and instead just milk the reserves, or drill the reserves they have left, or pump the reserves they have left. The question is, do you think these changes in capital budgets, are they changing what the future supply curve looks like? Is that part of what this glut gets weaned off from, is that we know there's less supply coming onto the market in the future?
Absolutely. I mean, because the shale, and that's where the new production is coming from, because it declines so quickly, if you're not, in manufacturing mode, basically, I mean, think about it as like turning out cars. If you're not turning out cars, you're not selling them. So you don't have them in the lot to sell. And that's been the pullback.
Got it. Okay. Very interesting. I wanted to go to another aspect because I thought this was one where you stood out as compared to what I see a lot of on Seeking Alpha, both in that discussion and in general, which is the natural gas side of this. And the simplistic way that I understand the thesis is that the bullet thesis for nat gas is that with all these oil shut-ins, associated gas goes down and thus supply is down, so the price of gas goes up, which is good for the existing pure play producers. You seem to be skeptical of this in the article, at least. What's your take on that thesis and why it may or may not play out so nicely?
I think that what you've identified is a critical factor, and I think that's why there was kind of an initial boost to natural gas. And I mean, natural gas, separate from oil, it's got all of its own dynamics. It's a great fuel. It's a clean fuel. I can kind of talk at length about how great it is. But what's also going on is that it's somewhat affected. The marginal takeaway for natural gas is LNG. And that's been, building in the United States, and there's been more capacity. Well, all of a sudden we're using that less. We're shipping less LNG. Partly it's reduction in demand from other countries, Asia. An interesting thing that's been pointed out is that outside of the US, most LNG is linked to oil pricing. And so oil prices go down and LNG from other parts of the world are a lot more competitive. So that's been a part of it. Part of my thesis is, and I remember when I first started kind of reading about natural gas, and I could not believe the number that in the Marcellus, there's 100 trillion cubic feet. There's so much natural gas. We have so much natural gas relative to what we need. So there's always an oversupply. It's much easier. It's faster to drill if you're producing natural gas than oil even. So there's always a lot of supply. It's harder to move around. you can only move it around really in pipelines or with LNG. Oil, you can put it on a barge. You can do all kinds of, you can put it on a tanker. Gas is trickier to handle. So there's that too. And then a big factor that kind of became apparent to me in the fall was that you have these state PUCs, state public utility commission. A big segment of natural gas demand is that it's taken over some of the inputs to fuel to utilities from coal. But you have these state PUCs in the Northeast and on the West Coast and other places that have said, we only want our utilities by 2050 and ideally 2025, 2030 to use clean energy. What that means is nuclear and renewables. And so so you have this nice market. I mean, think about it, if you're in New Jersey, right next to Pennsylvania, which has all this natural gas, but the New Jersey PUC and the Massachusetts PUC and the New York PUC are all saying, well, we just really don't want you to use natural gas. And so that has this kind of a dampening effect as well.
So it sounds like from the demand side, they're still sort of in between. It's still not the bridge fuel, but sort of the in between story.
It's a clean fuel for so many utilities in so many places, but there is, just like everything else, I mean, there's just kind of a divide, and there are definitely places that say, in Massachusetts is an example, they can't quite bring themselves to accept any form of fuel. I mean, whether it's wind, certainly, they're
right.
I mean, and so you wind up with some place like Massachusetts importing LNG from Russia. Come on,
Yeah, I'm a Massachusetts native. I remember. I don't know where they are now as far as the Cape Cod wind farms or whatever, but that was always a famous fight. But then also it's just the supply dynamic with there being so much supply. You're just kind of stuck where you're always going to be a price taker because there's always going to be somebody who's willing to drill and just compete with you, and so you're kind of stuck with a cap.
Well, and the thing is too, I mean, hopefully, if oil prices go back up and LNG goes back up, the global price, then the U.S. gets more competitive. It gets more, as oil production increases, even a little bit in the United States, you get all that associated gas. It starts coming back too, and that's forced into the market.
Right. Okay. Very interesting. So what are you watching for right now? Like, where do we've had? I think it's always exciting. Exciting, maybe not the right word, but always interesting in the oil and gas sector. But especially over the last few months, what are you watching next? Like, where do we're entering the summer season. Like, what are you watching for as important factors?
Just the same thing that everybody is right now in terms of demand, because this supply shock was so different from all the other, cartel fights, because here we took away, it at worst like 30% of demand. And so to see how that comes back, and are more people on the road and are more planes flying. So it's about, let's see, in the US at least, 91% of the transportation sector is oil related. So if you shut down transportation, you have an issue with oil, and we have. But as that comes back, and as people get on the road, and so demand is absolutely part of it. I'm always interested in what's going on with OPEC. I was kind of shocked, as were a lot of people, that they decided to have a big fight in the middle of a pandemic. But so hopefully they're kind of getting it together there. I mean, as I said, the state PUC, sort of how that develops in terms of, are they really going to kind of lock down on their utilities and say, hey, no more natural gas.
Do you expect OPEC just extend for a month? Do you expect us to be? Is this going to be an ongoing thing where each month that we have? I can't imagine that they stop having cuts, right? I mean, there must be some sort of sacrifice from the OPEC side to maintain the balance they want for a while. Is that fair to say?
Well, I think they always make the calculation, do we want, X amount at 40 or 50, or, Y amount at 15 or 20. And it's, getting everybody to agree is clearly, I mean, the biggest players are Saudi Arabia and in the OPEC plus Russia and the United States. And the United States, of course, is not a part of OPEC, but, they're paying a lot of attention to what we're doing. I'm not sure I answered your question.
No, I think it's fair to say that they're going to just continue to evaluate. I like that. Do you want Y at 15 or 20 versus X at 40 or 50 or whatever? And that's always going to be the calculus. And then whether they have other strategic concerns or whether there are less strategic things, but, mentalities that send Saudi Arabia to wage the price war at the wrong time or whatever else is always a factor.
Well, and what I was still so astonished by, and I'd still like to know sort of where it originated, was usually with OPEC, it's all marginal. So it's like, well, a million barrels here to a couple, who's doing what, and, we'll cut back a little bit. Did they not look at the market and say, oh, wait, 30% of the demand has gone away. That's going to, that's going to affect, I mean, who made that decision? So I was, hopefully they gained something from the experience.
Well, yeah, you'd think we all have learned from March 2020 when we look back. That would be our hope. So as a last question, what's a name or two in the industry that you like right now, and for what's the story?
I have written favorably about a number of companies for the public site, and then I look at sort of riskier companies for the marketplace site. But on the public site, one I've just liked for a long time is Chevron, the symbol CVX, and they have a lot of international operations. But what was so compelling to me initially and remains compelling, and I think I've said this before, is years ago, they merged with Texaco. Well, Texaco had this legacy position that turned out to be very valuable in the Permian. But they have all this, they've got all this acreage, and the royalties they pay are quite minimal. And so they are, they tend to be fairly quiet about it, but they have almost a better position than anybody, I think, in the Permian. So, and I, I kind of come from that perspective. And then I like the refiners because, I mean, everything's coming up, everything's getting really, and I've seen an analyst say, oh, I can't believe the refiners are, doing so well. Well, price of oil went down, so that helps. And the refiners were much quicker off the mark to say, okay, we're going to cut production, we're going to shut in some units that we, if we have to. And we're going to turn down our throughput to the extent that we mechanically can. I mean, you can't get much below 70%. A couple of people, let's see, I think it was Chevron, just, kind of just closed or shut down, some small refineries. So that whole group I like. One company that I talked about early on was Holly Frontier. And the reason I really paid attention to them was that their refineries and their markets are inland. And so when we were all saying, well, who's gonna, open up when, the inland markets, the kind of the Colorados and the Wyomings and the North, New Mexicos and Oklahoma's, all of that were sort of first out of the box. So I like Holly Frontier. I like all the refiners pretty much, but Holly Frontier's a name I would put out there.
Is Holly Frontier? I owned them for a while back when I was starting to invest without still learning what I was doing. They used to have quite a big special dividend policy, and so they would pay. And this is probably 2 cycles ago or something. But is that still something? Are they still something that attracts income investors?
Well, they have a dividend, and like every refiner, they have a midstream um, partnership. Now, were
Right.
you in the stock or the partnership? Because
I
the
was in
partnership,
the stock itself, I think.
okay, okay. I think it's a, I don't know that they've cut their dividend. I think they've just kind of maintained it. That's
Okay.
my sense is anybody who didn't cut their dividend, you know, Occidental cut their dividend and a couple other people, anybody who didn't also didn't raise it.
Right.
So,
Well,
so I don't know.
it's just fascinating how it again in March. I'm sure it was the same in the energy sector. I was looking at other stocks, but in March you're modeling out extreme stress tests and can they survive without revenue for X amount of time. And now we're in June 8th, and it's well, there's money in the market, so Hertz is up 62% today, or whatever the case may be. It's like the risk tolerance has just gone from 0 to 100, it seems, in the market as a whole.
Well, some of the uncertainty has been taken out, and it never hurts to have a few $1 trillion pushed out from the, the federal government. So that, you know, and there is this one of there was a one of the folks in the financial business was saying to me, you know, everybody's really saving money. So the short answer is, I think it's just huge stimulus dollars. You know, looking for a home. That's all I can. And the market's a leading indicator, so let's, I'm optimistic that that's meaningful.
Yeah, it'll be. I think it's just the tug of war is whether or not, even if we open up, what does that look like, and what does normal look like, and how long can we sustain that? Is I think going to be really the story. I mean, from my vantage point in the markets for the months to come, and so that will, because if we're back to normal now, then the stimulus was probably sufficient and it did its job. But if it remains to be seen whether that's the case.
Oh, absolutely. I mean, there are all kinds of uncertainties around the edges. I do know that people seem to be very, um, you know, there's places that opened up, and Texas is a place that's opened up, and Oklahoma. You know, was up in Oklahoma, and people are just like so relieved to, be able to go back into stores, and cashiers are like, oh man, I'm so glad to be back on the job. So that's anecdotal, but I think it's indicative of, and again, I mean, remember, this was government imposed. I mean, we were sort of sailing along. We're not any huge inherent problems that we were looking at in February. And then all of a sudden we shut ourselves down for I think the reasoning was as good as it could have been with the as little data as we had about what was going on with the pandemic.
Right, and I think your anecdotes point to my. I think there will be potentially a period of going back to normal. I don't think it'll be a flip of a switch for
Right.
plane travel or whatever else. But by the same token, I think the people who are extrapolating from the current period and thinking everything is going to change forever, I'm skeptical. I think some things, of course, will stick, but I do think we it's been 3 months versus the rest of our lives, and I think people will be eager to return to a lot of things that they've had in the past.
You can only stay in your house for so long.
Of course, I work from home normally, so that's been the least distracting part for me. But
Yeah, yeah. I do too. I do too. It's been easier for me, but I haven't had children at home to try and educate or anything like that.
that's right. I only have to deal with my cats, which is the same as same as always. So
So,
okay, I've been speaking with Laura Starks, who is the author of Econ-Based Energy Investing. You can find her work on Seeking Alpha. Just type in Laura Starks, and you'll find her marketplace service. You'll find her free site articles. Encourage you to check it out. Laura, any disclosures before we wrap up? Any positions?
I do own stock in Chevron, and I do own stock in a couple of refiners, Valero and Marathon. So when I talk about refiners, I do have those in my portfolio.
Okay, great. I still have a tiny position in DDG, which is actually an inverse oil sector ETF, and which has not has been it's a hedge, but it's not it's probably down about 30% at this point. So so it's not it's been I probably bottom ticked the oil sector,
Yeah,
but
yeah. We
that's
all
okay.
do.
Yeah, we've all got it's a small position again, so it's okay. So, all right, great. Well, thank you so much. This was a lot of fun to do.
I enjoyed it. Thanks so much, Daniel.
Absolutely.